So it's finally happened. Earlier this week, Chinese regulators asked Didi Global, which is China's largest ride-sharing service app, to delist its stock from the New York Stock Exchange over concerns of the company potentially leaking sensitive information. This move obviously comes after stocks like Alibaba have hit fresh new 52-week lows, and more recently stocks like Nio and Xpeng have also begun to roll over. This is really weird because all year most of the Chinese plays had been getting hammered, yet the electric vehicle plays stayed relatively strong despite all the fear around the Chinese government crackdown. But now that Didi and its board have authorized the company to delist from its American depository shares on the New York Stock Exchange, stocks like Nio and Xpeng and Li Auto are suddenly seeing their share prices under pressure. In this video, I'm going to summarize exactly what a delisting actually means and whether or not it could realistically happen to Xpeng or Nio. I'll also go over which one of these Chinese EV stocks is right now the better buying opportunity. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. There's obviously a lot of fear around this word of delisting, but if you actually do your research and understand what this process actually means, you realize that investors don't actually lose all their money in such a process. Unlike a bankruptcy, investors don't actually lose money in a delisting. When a company is going bankrupt, it's often because they're not able to conduct business and pay back their long-term shareholders and their debt owners. And when you have so many big loans and interest rates to pay and you're not able to pay them back, you either go in Chapter 11 bankruptcy or you completely liquidate all your company. And in such form of liquidation is when investors lose all their money, because legally speaking, investors are the last line of people that companies owe money to. Bond owners and banks are actually first in line. And typically when a company is going bankrupt and they have a stock that's listed on a popular exchange, their stock will often get delisted. However, with Didi, this company is not going bankrupt. This company is very healthy and it's operating at a very high level. The only thing is that China wants this company to be completely private or move its stock from the US exchanges to another exchange. There's two options that Didi could take from this process. One could be going completely private, where their shareholders will be paid back $14 a share, which is the IPO price this stock went public with a couple of months ago. The second option will be to move the free float shares from the US exchange to another exchange like the one in Hong Kong. This process could take around 5 to 6 months to actually happen, and when Didi moves to that Hong Kong exchange, the IPO price would obviously be at a much cheaper discount to that $14 IPO in the US. Because obviously there's going to be a lot of banks and investors that would not want to own shares in Didi stock anymore, and some people are going to be panic selling out of their positions. So if you own shares in Didi stock right now, your shares and your broker will automatically allow you to be able to sell your stock once the Hong Kong listing is live. And this is one of the big reasons why Didi stock actually went up after they announced this delisting process. So now that we know exactly what the delisting process is and what actually happens to investors and shareholders in such a process, let's understand why Didi is delisting in the first place. The biggest and by far the most publicized reason is that Didi could potentially give US investors and lawmakers access to Chinese consumer travel patterns. You see, Didi is essentially the Chinese Uber, and a lot of people use Didi very actively in China, especially since the streets and the cities are so small. The population of China also keeps getting bigger every single year, which is why to travel longer distances and going to work, people find it more economical to take an Uber rather than drive a car. However, on top of this potential national security threat, there's another big reason why Didi is also delisting. To go public on US stock markets like the New York Stock Exchange or the Nasdaq, you actually have to go through a much weaker scrutineering process and much less regulation. The Hong Kong Stock Exchange actually requires you to be a very profitable business before you're able to list on their markets. And since Didi is actually growing at a very high rate, they don't have that perfect profitability locked in. And that's actually one of the reasons why they ended up going to the US market instead of the Hong Kong market. And it's exactly because of this, Chinese government officials have this extra skepticism about the company potentially leaking Chinese geopolitical data to the US because of this much less stringent scrutineering process. However, the bottom line is that US investors will not actually lose all their money if Didi gets delisted or if they go private. Now, even though Didi was actually a very big IPO in the US, most US retail investors are not actually very familiar with the company itself. When it comes to Chinese companies that are listed in the United States, the most popular companies by far are actually electric vehicle companies. companies. Xpeng and Nio are by far the biggest EV players outside of Tesla, and even though over the past 6 months or so as Alibaba and so many other Chinese stocks have been getting hammered, these two stocks have actually held up relatively well. But more recently, over the past few trading days in the past week, we've seen a lot of volatility in both of these stock prices, with Nio especially not having moved that much over the past month. And this is leading a lot of investors to ask the question as to whether or not Xpeng or Nio could also potentially be delisted by Chinese regulators. And in my honest opinion, I do not think that will actually happen. You see, both Xpeng and Nio have actually been public on the US markets for well over 2 years now, and China has really shown no concerns. With Didi, when they went public in May or June of this year, there was immediate concern from Chinese officials as to whether or not this company should actually be listed on the US market. We saw so many probes and so many investigations back and forth between the US and China about this Didi IPO from right out the gate. And I think there's a couple of big reasons for why that was. You see, China actually needs a lot of US investors to capitalize their own high-tech businesses and create a sense of dominance. We all know how passionate US investors are about investing in innovative companies, and China is arguably one of the most innovative technology giants in the entire world. And since the EV sector is China's biggest lead right now, a lack of US capital could really hurt the growth of their Chinese EV companies. And given the dominance that China wants its companies to have in the technology space, delisting the companies off of the US exchanges would probably be the last thing they want to do. And it's not like Nio or Xpeng have any crucial data that they could release to US investors. We all know that right now there are 3 major Chinese companies that are listed in the US markets that actually have a lot of revenue and a lot of growth ahead of them. These companies are Xpeng Motors, Nio, and a company called Li Auto. And even though Li Auto is argued as a very strong EV player in the SUV space, those guys actually develop hybrid vehicles and not fully electric cars. Which is why for me the question is actually between Xpeng Motors and Nio instead. Nio has definitely been public for a much longer period of time than Xpeng Motors. However, both of these companies have actually been in the EV space for a very similar amount of time. And even though there is a much stronger retail trader and investor community around Nio than there is for Xpeng Motors, I do believe that Xpeng Motors is actually growing much faster than Nio right now. Not only have they been growing quarterly sales and revenue much quicker, these guys also have more products and they're improving their gross margins at a faster rate than Nio is right now. On top of this, Xpeng is also in the flying car and high-level autonomous driving space with a lot of government backing. And if you pair that with the fact that Nio right now is only selling cars in the SUV space, meanwhile Xpeng is selling everything from mid-size SUVs to compact sedans and sports sedans, makes it very compelling to be an investor in Xpeng over Nio. You see, Xpeng has only recently begun sales of their $25,000 electric car that actually has LiDAR technology built in. This tells me that these guys could be at the very beginning of their growth curve in a very high profit margin area. Because we all saw how Tesla was able to ramp up their sales with their cheapest car, which was the Model 3. And the Model 3 is really what brought Tesla into profitability and into the eyes of Wall Street. And given the fact that the Xpeng P5, which is their compact sedan, has only done around 2,000 to 3,000 unit sales right now, tells me that there could be a very big growth opportunity for this company over the next couple of years. As you can see in November's delivery numbers, Xpeng is leading the charge out of all 3 of the major Chinese EV companies with a total unit sales of around 15,000 that was up 270% year over year. Meanwhile, Li Auto grew roughly 190% and Nio only grew at around 105%. Now don't get me wrong, these numbers are very good, but if you're making a comparison between these 3 companies and their growth rates, Xpeng is a clear leader. Let me know which one of the Chinese EV stocks is your favorite and how many shares of that particular stock do you own down in the comment section below. But anyways guys, I hope you enjoyed this video and I'll catch you guys in the next one. Take care.